so much pressure with the recording thing, right? So what I thought I would do today, what Philip and I talked about, was giving you guys just a brief economic overview of what's going on in the market. So we're going to get completely dork out and geek out on the economic stuff, and then we're going to get into different lending products that might help you guys with your sub-twos, with your BRRRR method, different strategies that you might be working, because different investors work different strategies, and different strategies work for different houses, right? Yep. You guys stop and ask me questions along the way. I'm very casual, easygoing. All right, ready? He's going to be my Vanna. All right, so we're going to start with some economic update. My stand over here. All right, yeah, you can smudge my glasses. They have fingerprints all over them. All right, you want to go to the next slide? So from an investor standpoint, when you guys are looking at buying investment properties, there's 4 things that I think that you guys should pay attention to as far as economic highlights, right? Unemployment, supply and demand, inflation, and then credit criteria. So we're going to cover the 3 of the 4 today. So unemployment. So the March ADP, 184,000 jobs were created. Now we care about unemployment as investors because why? You guys are so, you need to calm down a little bit. We care about it because that's your tenant or that's your buyer, right? So if everyone was unemployed, would they be able to rent in your house? No. Would they be able to buy your house? No. So you care about unemployment. If unemployment gets out of control crazy, then you need to say, oh my gosh, I need to be careful. I need to make sure that I have extra money in reserve. So if my tenant decides not to make the rent that payment because they're now unemployed, so you see the trickle down. Okay. All right. So 184,000 jobs were created, which was slightly weaker than the 150, was stronger, sorry, wrong word, than the 150,000 expected. What you want to also pay attention to is how many jobs were created, and then are people making more money or making less money, right? So typically when you change positions, you make more money. Maybe that was the driving factor of why you changed the position. Yes, ma'am. Oh, she remembered to pay attention to wait for the mic. Wow, good for her.
Hey, so I'm just wondering, is this nationwide numbers that you're giving?
Yep, these are national numbers. Yes,
okay.
Thank you. Yep.
All right, thank you.
Yep. I do everything global, national. And is anyone here investing in a different market besides local? Yep. Okay. All right. So this is ADP. Let me back up for a second. This is ADP. So ADP is a private company, right? Corporation. And then you have, so ADP puts out a monthly report and the government puts out a monthly report. The government's report is the BLS, Bureau of Labor Statistics, and ADP is the private sector. I personally like the ADP better. I think it is more reliable. It is actual data from ADP. ADP, you know, is the payroll company, right? So it's their actual data from actual payroll. So I think that's important. I like ADP better than the government. The government has lots of different ways they calculate, and they've got sub-reports within their reports, and sometimes there's some pretty extreme differences. So when you're listening to the news and you say that unemployment came out, that's from the government's report versus ADP's report. Make sense? So the media has lots of different ways. So annual job stayers, it was flat. So if you stayed at your job, did you get a raise? No, you didn't. It was flat. But if you moved from one job to another, you did get a raise. And typically that's why you're moving, right? I'm going to make more money at this company, so I'm going to go and change. So what was important, the chief economist at ADP says that March was surprising not just for the pay gains, but the sectors that recorded them. The 3 biggest increases for job changers were in construction, which we're all fully aware of, financial services, and manufacturing. Inflation has been cooling, but our data shows pay is heating up in both goods and services. So it's important just to kind of pay attention to what's going on in the world as far as unemployment. The next one we're going to talk about is supply and demand, right? So if there's no supply out there, which is what we're all very familiar with, right? Then you have to have maybe a different strategy, or you might have to just think differently versus if there was a ton of supply out there, right? So when you take a look at, this is from National Association of Realtors, national number, when you take a look at the month over month and the year over year, so month over month we were down 4.3% from last month, but year over year we're down 3.7%. So as we can all feel, the inventory is super tight out there, right? And it's getting, this says from month to month, it got a little tighter. If you take a look at the inventory, we have 3.2 months supply of inventory. That's getting a little bigger, a little more generous, believe it or not. 4 months is a normal economy for us to be in a nice balance between supply and demand. It would be 4 months, and we only have a 3.2. So as we can all feel, it's tighter out there from an inventory standpoint. And so then the quote from NAR, their chief economist, Lawrence Yun, who I love his, if you ever pay attention to anyone, he's almost always spot on. If he says, I think that this is what's going to happen, pay attention to what he says, because I think he's almost always spot on. He says, though rebounding from cyclical lows, home sales are stuck because interest rates have not made any major moves. There are nearly 6 million more jobs now compared to pre-COVID highs, which suggest more aspiring home buyers exist in the market. So we all know the demand is out there, right? We are part of that demand. We want more investment houses to be able to be, that we can buy, right? So we know the demand is out there. People have more employment now than they did before COVID, but as you can see, we have less inventory. So it just constrains it, makes it even tighter. So new construction typically makes up about 10% of the total existing inventory out there. Lately, it's made up as much as 30%. Now, some of that is because builders are building more houses. Some of that is also because inventory is so low that the new construction is just a larger piece of it. Make sense? So on new construction, you can see we are down across the board from permits to starts to construction, right? Now, these three things are very important because if you don't ever get it permitted and you don't ever start, you're really never going to build it, right? So these things are really important, but what you want to really pay attention to are the completions, because a house cannot be on the market to be occupied until it's finished, right? So they can start them and get permits and start building it all day long, but if they don't have the materials or the labor or the liquidity from the builder itself to complete the house, it never gets put on the market. So the completions are the things you really want to pay attention to. All right, so let's talk about supply and demand in a reality standpoint. So when we talk about household formations are when your daughter moves out of the house and then she goes and she buys her own house, right? Or my college student comes home, I gave him 6 months, you got to pay rent, and then you need to get out, right? So when you look at this section right here, these are millennial home buyers. So we all know the millennial generation is the largest generation since the baby boomers, right? So the baby boomers would be probably over here somewhere, and then maybe you are over here, and then the millennials are here, right? So the millennials are the largest populations ever that we've had. So you can imagine that's tremendously high demand, right? So we're not building houses fast enough. And remember, every year we lose some inventory, right? Houses catch on fire, they get condemned. Not many, like about 100,000 houses a year leave the inventory from existing houses, but only about 10% more on average get added from new construction, right? So you can see that our inventory is really low compared to what our supply is. So that's what's really constraining right now the supply and demand imbalance, right? It's people. We have more people who want a house than we have houses for the people. Make sense? And that's not going to go away overnight, right? Because if they're right here, you still have this much of the population years to go, right? And then the population behind them really isn't that much smaller than millennials, right? So I think we're going to have this inventory, supply, and demand imbalance for a while. I think it's going to be tight for a while. So why that's important for you guys to know is don't just sit there and wait for things to change. I don't think they're changing anytime soon, or they're not changing in the next 3 to 5 years, right? So then what that tells you as an investor is how do you adjust your strategy? How do you adjust maybe your business model? How do you adjust what you're doing? You know, do you pivot and do you go to a different, we mentioned pad split earlier. So do you go to a different strategy because you're really having a hard time, or do you go to a different location? I'm having a really hard time doing what I think I'm doing. Okay, do I need to pivot a little bit? So pay attention to supply and demand. I don't think it's changing anytime soon. So just kind of keep that in your mind when you're working on your personal business strategy. All right, then we're going to talk about inflation. It's in the news all the time. So the PCE is the personal consumption expenditure. This is the Fed's favorite measure of inflation, right? So you hear about the CPI and the PPI and all these, we try to confuse you guys intentionally. So you hear about all these acronyms, right? This is the Fed's favorite measure. So this is the one they're looking at the most. So the PCE reflects changes in prices of goods and services purchased by the consumer. So when I go to the grocery store, how much do my groceries cost? How much does my gas cost, which I only have 10 miles, so I gotta fill up before I go home. So like how much does that kind of stuff cost, right? That's what's measured by the PCE. It measures consumption expenditure, meaning how much money do I personally have coming in and how much money am I spending out on my groceries and my gas and my rent and things like that. So it's a nice in and out measurement. It's a nice full measurement. So this is also what dictates, and one of the main measures that dictates what the Fed says inflation is. So inflation rose last month 0.3% for March. That was in line with expectations, but it went up. That's the wrong direction, right? We're all looking for it to come down, and the Fed's looking for it to come down before they ease up on interest rates, right, or lower interest rates. So it's going the wrong direction. Odds are it's going to go in the wrong direction for the next couple of months. We know that because we can see the data that's coming, the numbers that are coming out. So the inflation number is literally a 12-month rolling average, right? So you take 12 months of percentages and you average them together, and that's where you get 2.5, 2.7%, right? So when 1 month falls off because another month is added, we can kind of see what are the next few months that are going to be falling off, what do we think they're going to be replaced with, and you can see with what's falling off and what's coming, odds are it's going to be going up for the next couple months. So when you watch the news and they say, oh, inflation went up, you'll be like, gosh, I knew that. I knew that was going to happen, right? All right, so inflation year over year rose from 2.5 to 2.7%, slightly higher than expected. The core, which strips out food and energy, because the government says, I can't control food and energy. The government thinks they can't control food and energy, and so they strip that out, and then they look at that piece of data. So the core rose 0.3%, which was close to expectations. Now, personal income, this is, remember, me as a person, how much money am I making versus how much money am I spending on my gas and my groceries, right? So my personal income rose 0.5% last month. My spending rose 0.8%. So during COVID, we all got slightly crazy, and you know, I'm a chick, so I spent a lot of money online, right? So we all got a little crazy during COVID, and the checks were coming in, and the U.S. consumer is spending a lot of money. They have not tampered down those habits and behavior. They are still outspending what they're making. So that is cause for concern. Savings rate is down to the lowest it's been in quite some time at 3.2%. That's hardly anything, right? So what that tells you is the U.S. consumer is living on the edge, right? Their credit card debt is higher. They're spending more than they're making, right? So they're eating up their savings or they're putting it on their credit cards. Credit card debt right now has hit 1 trillion with a T. So it's crazy number, right? Why do you guys care about this? Because you have tenants and because you have buyers and you have sellers, and just being aware that the consumer is living on a much, more paycheck to paycheck than in the past few years is important just to keep in the back of your mind when you're negotiating with a seller. Maybe that helps. Maybe you start asking questions, the leading questions like, do you need to sell this house for a reason? They probably do because they're debt, right? So it kind of just helps you guys have in the back of your mind information that's going on in the world that might help you as an investor. You're doing really good, Vanna. Doing really well. Thank you. So this is the conventional mortgage rates. So we're going to talk about our kind of lending in a second. Not many investors use conventional loans, but this is one thing that is measured from Wednesday to Wednesday every week. And so I kind of use this just as a barometer, right? What's going on in the rate world. So according to Mike Frantantoni, and I had to introduce him one time at a meeting, and trying to say his name in front of a group of 200 people was really nerve-wracking. It does not fly off your tongue, just FYI. All right, so he says, super smart guy, he says that inflation remains stubbornly high, and this trend is convincing markets that rates, including mortgage rates, are going to stay higher for longer. The Fed has come out, and there was Fed notes last week after their Fed met, and they have come out and said, we're just going to pause. We're just going to take a wait and see, for now. Again, inflation is most likely not coming down the next few months, so they certainly have no reason or incentive to lower the Fed fund rate, which then impacts the mortgage rates. So you can see we've done nothing but go up. This is for owner occupants. So if you're who's here a realtor? Any realtors here? If you're a realtor and you're selling to owner occupants, this is what their rates look like right now. typically investor rates are 1 to 1.5% higher than what the owner occupant rate is. So if the owner occupant rate is probably in reality 7.5, then you're looking at 8.5 to 9 for an owner occupant rate. Surprisingly enough, the DSCR rates have not moved a whole lot in the last 6 months or so, and you can get anywhere from a 7 to 10% DSCR rate, and we'll talk about that in a few minutes. All right, I'm going to pause for a second because I know I talk really fast. Any questions on economic stuff? Yeah, there you go.
So you mentioned about the inventor, US-wise. Where can we find just for Virginia or Richmond?
I can only tell you for this local market what I feel and when I'm talking to my clients and investors on a regular basis. I don't have any statistics, but I can tell you that it feels like, and you guys tell me if you agree or disagree, it feels like Richmond is, there's been a lot of movement into the Richmond market from more northern markets, right? We've all heard this story where Northern Virginia, New Jersey, New York, people are selling their houses. They're making so much from selling their house. They're coming down here, and to them it's such cheap housing, right? They're offering over ask price, or they're offering cash, or they don't care. They're going to pay 20 grand more because they think they got such a great deal in comparison to what it was where they moved from, right? That's forcing the average sales price to go up, and then that's forcing supporting comps, other solds in the neighborhood, to go up. So it's kind of a snowball effect, right? So I would say in the Richmond market, I feel like our prices are a little higher than what they should be because of what they call a migration, people moving from other areas into this area. I can tell you there's also local places here where, like Petersburg, for example, like you used to be able to get a lot for $1,000, and now you're spending 20, 30 grand for a vacant piece of land, right? So I think overall, obviously, prices are up because of demand. Inventory is low and demand is high. And I think here in this Richmond market, it's probably even a little higher, just because I feel like those prices have been forced up a little bit. Would you agree?
Yeah, I would agree. I have a question.
Yes.
With the data that you end up pulling, do we have access to that, or is there a website we can go to kind of see the rolling, like 12 months of inflation?
For inflation?
Yeah.
I don't know. I mean, you could just Google 12-month inflation chart. There's this website called FRED. I know it's an acronym. I don't know what it stands for. But if it's like FRED.com or .net, something like that, and it's a big graphing. You can say, what's the weather been for Richmond for the past 30 days, and it'll give you a chart of what the weather has been for the past 30 days. So if you go to that website and you just type in inflation, it'll give you a chart on what the inflation's been for the last 12 months. Yep, the internet's a wonderful thing. All right, so we're gonna talk about financing for a couple minutes. I'm gonna give you guys a brief overview of just as an investor. I assume everyone here in the room is an investor? Yes? I'm going to give just a brief overview from an investor standpoint, what your options are from a financing standpoint. And you guys just stop me if you have any questions. So as an investor, you guys are probably fully aware that you have private money loans as an option. You have conventional loans, which we mentioned before, as an option. And then you have this thing that I do. It's called commercial loans. It's still on residential buildings. The type of loan just happens to be commercial because it's for a business purpose use, right? So you as an investor, that's your business. It's in the name of an LLC. So it's still on a residential property, but it's technically a commercial loan. So private money is typically short-term, 6 to 12 months. It can include rehab money, and typically you don't have to qualify based on credit or income. Conventional is only long-term, so opposite. Only long-term, house must pass appraisal, must be in good shape, and then the borrower must qualify based on income, credit, and debts. And then commercial kind of straddles the two, right? So in my world, I can do both short-term money and long-term money, but mine are to businesses, to investors, to LLCs. So we can do renovation, new construction, or rental, so short-term and long-term, right? And then we qualify based on the property itself. Yes, you as an individual need to have good enough credit because we need to trust that you're going to make your payment on time, but there's no income involved. So if you can see this one, these are kind of the extremes, and then this one kind of straddles kind of right in the middle. All right, so we're going to talk about short-term financing options first. So short-term, obviously the goal or the use of what you would use a short-term loan for would be to renovate a property, to build a new construction property, or a bridge. Bridges are really not used that often. Bridge is more for, it's a short-term loan just like a rehab or a new construction, but there's no renovation or construction money built in. I just need to hold a house. I need to have a loan on a house for 12 months with no renovation. Again, it's not super common. So we all understand what a renovation or construction is, right? Yes? Awesome.
I have a question in regards to that. Do you guys do double closes?
No, we do not.
Okay.
We do not. And I won't even go down that rabbit hole. No, I'm just going to leave it at that. We do not. All right, so short-term highlights. So for us, and I'm what they call an institutional lender. So we are a big company. We have big buckets of money that come from Wall Street. So it's not like my personal income or a fund that I've created. It's Wall Street money that we use. So these are my guidelines. So you would definitely ask whatever lender you're using. You would definitely want to ask the questions I'm going to explain to you here. So on a commercial loan, there's no personal income required like when you go to buy a house to live in. So when you go to buy a house to live in, they have different lending requirements per the government than if you're buying an investment property. So if you're going to go get an owner-occupant loan, it needs to be what they call a qualified mortgage or a non-QM. But you're almost always going to have to give income, credit, debts. There's just a different set of rules for those houses than for our houses as investment properties. So there's no personal income on mine. Typically short-term is interest only. You're not gonna, it's 12 months. You wouldn't pay anything into the principal anyhow. So it's typically interest-only payments, typically for 12 months or less. Now some hard money lenders might do 6 months or 9 months. For me, it's 12 months or less. So if you use 3 months, you made 3 months payments, you're done. That's it. There's no penalty or minimum number of months payment. Typically your loan to cost. So loan to cost is, I buy a house for $150,000, I'm gonna put $50,000 in rehab into it. So my all-in total cost is $200, right? So my loan to cost is, am I gonna put a 10, 15, or 20% down payment? So that's my loan to cost. Make sense? Yes? Okay. Cash to close typically is your down payment, your reserves. We require 10% of your budget because we want to make sure you can go get the job started. You've got enough money for all that. And then credit score and experience. Where I work, we're a 660 minimum credit score. So it depends on what lender you're using as to what their minimum credit score might be. We will lend to a zero experienced investor. That could be your first one. You're just going to make a larger down payment to offset that risk that you don't have experience. But some lenders won't lend to a zero experience. They require you to have experience, which is a little bit of a catch-22. Like, how do you get experience if you can't? Yeah, you get it. She gets it. Yeah. All right, so now we're going to talk about long-term. Let me pause for a second. Short-term, any questions on that? Everyone get that? Kind of easy? Okay. All right, long-term. So long-term would be DSCR, which we talk a lot about, short-term rental and portfolio. These are actually the same thing. This is just allowing you to do a short-term tenant on a long-term loan. Does that make sense? Okay, so a DSCR really is, so does anyone know what DSCR stands for? Good job. I knew I liked you. All right, so debt service coverage ratio. So all it means is what's the rent coming in versus what's the mortgage payment going out, right? So let's say we had $1,200 a month rent coming in and we had $1,000 a month payment going out, right? That's going to put us at a 1.20 DSCR, right? So you've got 20%. You have that $1,200, so you have $200 more a month coming in than you have the payment going out, right? So what you really, a break even would be $1,000 in rent coming in and $1,000 in mortgage payment going out, right? That would be a 1.00. Or if anyone here plays golf, we call that par. So that would be a 1.00. So you really want it to be positive, right? You don't want to break even. Why would you keep the house unless you think in the year's future you're going to make money, right? So you really want to be positive from the get-go. You really want it to be a 1.10, 1.20. You really want to be getting 10, 20 more % of rent coming in than that payment going out, or else why are you holding the property, right? So that's what the DSCR calculation is. So a DSCR loan is a 30-year fixed rate we have ARMs, but I wouldn't do an ARM right now. Why bother? 30-year fixed rate. They could be interest only. I actually now have a 40-year. It's a little crazy right now, but that's a typical DSCR loan. It can be used for an annual lease. It can be used for midterm rentals, and it can also be used for short-term rentals. So for a short-term rental, we're either going to use the rental income if it's already been rented as a short-term building rental for the past 12 months. We can use that history on the actual property, or we can use something like an Air DNA and use income off of that. And then portfolio really is just, it is a DSCR loan, but it really is a group of properties under one umbrella loan. So it's one loan, typically no more than 10 properties within that one loan, but it's all a DSCR. It's a DSCR loan. Make sense? All right, so some highlights about the DSCR. Again, no personal income. I don't ever ask you what you do for a living. I don't want to know. It doesn't matter, so I don't want to know. You're just going to complicate my brain. I just don't want to know. So it's either a 30 or a 40 year. It's fixed ARM or interest only. There is a prepayment penalty option. So a prepayment penalty means a lender expects to make X amount of money on that loan they're going to give you, right? If you pay off that loan because you sold the property, you refinanced it, you won the lottery and paid it off, which doesn't happen, right? If you prepay that loan, then the lender's not going to make the money they thought they were going to make, right? So if you do it in the first 3 to 5 years, so what the lender's going to do is charge you a fee. So if you sell the house in the first 3 to 5 years, they're just going to charge you a fee to make up the money that they probably lost because you didn't keep the loan long enough. So 3 and 5 years are the most common. You can have anything from a 0 to a 5. You don't want to do a 0. It's not worth what you're going to pay. You're going to pay a premium for that 0, right? Not to have a prepayment penalty. So you're going to pay it one way or the other. You're either paying it in a lower prepayment penalty or you're going to pay it in the actual fee itself. Make sense? Okay. So 3 and 5 year are the most common. And there's usually like a 0.25% higher in rate for a 3 year versus a 5 year. It's just a different option. All right, so we can go up to an 80% loan to value typically, assuming your credit score is high enough. Cash to close usually means down payment and reserves. I got to take that budget part off. This is long term. And then again, questionable. It depends on what lender you're using, what their credit score and experience requirement is. Again, my credit score is minimum 660, and I don't have an experience requirement. All right, questions? Come on, go for it.
For the 40 years,
Yes.
how does one investor qualify for the 40 years versus the 30 years?
It's no different. It is crazy right now. So we have a new investor now, and the cost for a 40 year is no different than the 30 year. Like if I said to you, hey, your rate is 8.5 at 2 points. Do you want 30 year or do you want 40 year? So the rate is the same. It just it stretches it out. Instead of over 30 years, it stretches it out over 40. So what that's going to do for you, and because the housing has become so expensive, right? The various investors and the government, even Fannie Mae and Freddie Mac, which is conventional lending, they're actually most likely going to be coming out with a 40 year because housing has become so expensive, like car payments. We need to stretch it out over a longer time period. So it used to be a premium. It used to cost more to get a 40 year, but by the time you pay more, but you stretch it out over 10 years, they kind of offset each other. So it really wasn't any benefit. So the investor came back and said, okay, we'll charge the same price. We won't charge a premium, they call it, for that extra 10 years. So if you've got someone, especially like when I'm looking at my younger investors, they've got plenty of time. They're really not going to keep it for 40 years anyhow, right? But it really makes your monthly PITI lower so that you can get more cash flow every month.
Yeah.
So it's kind of cool. And I can always run different scenarios. I can say, here's your 30 and here's your 40 and here's the difference between the two. It's pretty cool.
And you end up mentioning, pad split, because I know
Yes.
you're going to get into that. But pad splits, what kind of product does that fall under?
DSCR.
Okay.
Yep.
And then what are the requirements for an investor to be able to get a pad split loan? Like what kind of seasoning period that you guys need?
Yeah, so our
etc.
seasoning's a great question. Our seasoning is 6 months. So what seasoning means is that you've owned a house for some period, you've done something for some period of time, right? So you guys might hear, well, I need those funds to be seasoned in your bank account, right? So I have people who call me and they're a brand new investor and they've been saving their money and it's literally in their floor or it's literally in a box in the closet, right? Okay, I can't take cash, right? So I need you to put that in your checking or savings account. And I have all these federal anti-money laundering laws that the federal banking system puts into place on all lenders across the board, right? So you might see this in other aspects of your life. So if you all of a sudden go and drop in 20 grand in cash in your bank account, I'm gonna say, dude, where'd that money come from, right? And I have to be able to source where that money came from. It may come from a house that you sold. It may come from a bonus check that you got. It may come from Grandma Louie, I don't know, right? But I need to source where it came from. I have to prove it came from a legitimate legal source, right? Because we're proving the opposite here. So sometimes people are like, well, I can't prove that. It was just cash in my shoebox in the closet, right? So then you would have to put that money in your checking account and you would have to wait till that money is seasoned, meaning you just have to wait a period of time. I'm only going to ask for 60 months bank statements, right? So if you put that money in 3 months ago, I'm not going to know that because I won't see that large deposit. That happened 3 months ago. I only have your last 2 month statements. Make sense? So seasoning really is just a time period for something to happen. So when you buy a house, and let's say you're doing the BRRRR method, right? We all know what that is, yes? So let's say you're buying a house and you buy it, you fix it up, you get it rented out, and now you want to refinance it because you decide you're going to keep it, right? Whether you intended that in the beginning or you had to pivot and something changed and now you're going to keep it. Let's say you've only owned the house for 4 months at that time period. I'm going to say to you, it's best if we don't close until 6 months because then you're going to get the benefit of value. So until that house is seasoned, I can only lend based on your acquisition cost. I can only lend based on, I bought it for this, I put this much money into it. So let's say, back to our example, we bought it for $150 and we put $50,000 into it, right? So if you do it in less than 6 months, it's not seasoned. So I can only lend based on that acquisition cost, that $200, right? But let's say the house is worth $250, $275, that's what you want, right? Then if we wait 6 months and the property is now seasoned, now I can lend based on that $275. So the equity that you think you have and you want to pull some cash out, you want to liquidate that equity, we have to wait 6 months until it's seasoned. So pad split, we're definitely, in any property we look at to refinance, you're definitely going to want to wait the 6 months till it's seasoned.
I'm also just wondering, you can get amortized loans as well with DSCR, correct?
When you say amortized, what do you mean? Like the 30-year or 40-year amortization?
Yeah, you can do the amortization with those though as well?
Either 30 or 40 year though. We don't do anything less than 30 year.
Okay, thank you.
Specifically going back to the 40-year, I may have missed it. So kind of like two questions. So I believe you had said that there's no additional like cost to do the 40-year, and if so, could you explain what those are? And then secondly, is that something that I would have to request, or is that kind of like becoming the default now where you just underwrite it for 40 years?
Well, I mean, you don't have to, so there's no extra different qualification for it to answer the first question. And then if you and I are working on numbers, you're just gonna say, hey, Lindy, show me the 40-year. And then you're gonna say, oh, I want the 40-year. And then I just click the box and you get the 40-year. Yeah, nothing different, nothing special.
So I might have missed it. The short-term loan that your firm gave for 12 months.
Yep.
What is the typical interest rate?
Oh, good question. I didn't cover it. Interest rates on short-term money range between 10 and 14%, and there's different qualifying factors that impact your rate, whether it's short-term money or long-term money, right? So on the short term, it's your credit score and your experience level. That's what's going to impact, is my rate 10% or is my rate 14%? So let's say you had a 760 credit score and 10 in experience. Okay, you're going to be down the 10%, maybe 10.5% range. If you're a brand new investor, you have 0 experience or maybe 1, and your credit score is under 700, then maybe you're going to be in the 13, 14% range. So you can see how risk impacts what your rate is. So if you've got better credit, more experience, you're going to get a better rate. That's not to say, though, that you can't improve. Some people start out at the lower end because they don't have the experience, or maybe they're still working on their credit, and then over the years they get more experience, they improve their credit. The rate's going to change on every loan you get.
areas in Richmond that you're seeing require a little bit more underwriting? Because I know some lenders, like, they're more weary of doing like Petersburg or the
Yep.
Colonial Heights area versus like here in the city.
Yep. So a difference between a private money lender versus what we call, again, an institutional lender would be, I don't have areas I won't lend in, even if it's a declining market. So even if on the appraisal, the appraiser says this property is in a declining market, we'll still lend on it, but we're just going to trim your LTV down by 5% probably, right? So there's a lot of private money lenders, they get to make up their own rules. It's their money, right? And so they say, I don't like Petersburg, I don't like Colonial Heights, I don't like Hanover, I don't like Stafford. They can say, I don't like this. They can also say, I don't have any money right now. So they are very deal by deal, and they get to make up their own rules on their own money. But we as an institutional lender, corporation, again, we don't have, we're pretty, you check the box, you get a loan.
What about origination fees? What do you guys charge? Are you doing a direct, or is it kind of that plus a broker's fee on top, or how's your, I guess that's how you're structured?
Yep, and that's a cool shirt you have on. As far as fees go from a lenders, and you guys can ask me, like, I'll tell you all the secrets, right? So when it comes to fees for lenders are in the business to make money, right? They're going to make money on the interest rate. They're going to make money on their fees. Fees, in my opinion, fee is an overarching topic category, right? Underneath fees, there's points, origination, and then what we in the industry call junk fees, right? So a junk fee is like a processing fee, an underwriting fee. Usually anything that has the word fee behind it is a junk fee, right? And that's the way that the lender is able to make additional money so that they can make enough money on that loan to do business, right? So when it comes to interest rates, there's these things called discount points. So a discount point is 1 point equals 1% of your loan amount. So in our example of 150 plus a 50, and let's say we were all in at 200, let's pretend like our loan amount was 200, right? So 1 point is 1% of that 200. That would be $2,000, right? Typical investor points would be 2. So if you were going to get an 8.5% rate and it was at 2 points, then your points on that $200,000 loan was $4,000. Make sense? So think about a scale. So when I run quotes for you, I'm going to do like a little snippet of what my actual rates are that day. And you're going to see the lower the rate, the higher the points. So think of it as a scale when it comes to interest rates and discount points. The more in points you pay, the lower your rate's going to be. So when you hear someone say, oh, I bought down my rate, and they think they're special, right? All that means is they paid more in points and got the rate lower, right? It's as simple as that. So when you ask me a question on how much are my fees, I have a $15.95 processing fee, and that's it. But when you guys are talking to other lenders, and especially private hard money lenders, they can make up whatever they want, right? I'm regulated a little bit more than, they're not regulated, I'm regulated, right? So I'm charging a $15.95 fee across the board to everyone because I have to be fair and even to everyone, right? Private money guys might say, well, today I'm going to charge this much or I'm going to charge that much. They can do that, right? They also might have a repeat customer. And for that repeat customer, they give them a better rate or they give lower points. So just be careful and get a full list of what the fees and expenses that you're paying. But so I would say I'm going to give you whatever the pricing is that day. I'm going to pick something in the middle just to run some figures for you. But when we go to lock in your rate, I'm going to send it to you again, and you're going to tell me, I want this one or I want that one. That's your call, not mine. I'm going to give you your options, and then you're going to decide how much do I want to pay in points for whatever the fee, whatever the interest rate is.
With the experience aspect, I'm wondering how much of your private life, like, would you be able to bring in documentation even though in your business you might not have the experience, you're just starting out?
Yep.
So if you have documentation showing what your skill sets are
Yeah, it's not going to matter.
before you got it,
Yeah, it's not going to matter.
that's what I was wondering.
Yeah. When
So
she
you
went private
literally
life, I
have
was
to get
wondering where
in
she
and
was
do
going
the
there.
thing to get the experience points
Yep.
on the
So
business
for
side. Okay.
us, the definition of experience is how many investment properties, so not your owner occupant, how many investment properties have you bought or sold in the last 3 years that you did renovations on, that you had ownership in? So I had a guy call me yesterday. His family owns a property in Florida and he wants to refinance it. Well, it's not his property. It's because his name is not on it. It's still in his family name, right? So even though he's active in managing the property itself, he doesn't have ownership in it. So it's 4 things. It's investment properties in the last 3 years that you did renovations on. Because if you just bought and it's a rental, that's rental experience, but that's not rehab experience, right? That you had ownership in. Now, it could be in an LLC, and there's 4 of you in the LLC. You still had ownership in it, so that still counts. So that's our definition of experience.
Does your company lend outside of the Virginia area?
Yeah, we're national.
Okay.
Again, we're a corporate institutional lender. Oh, Mr. Investor T-shirt, the other question that you asked was broker. So we are what they call a direct lender. So it's our money. You're going to use our warehouse line. It closes in our name. Now, we are going to sell off the servicing like all lenders do, usually within 30 days of closing, and you're going to send your payment physically to someone else. We still have a servicing group that then coordinates and works with whomever that servicer is, right? We have a designated one for short term and a different one for long term, but we're not a broker. We're a direct lender. You guys want to be aware of that too, because I work with brokers. And if a broker is using my money, then they're charging a broker fee on top of it. So I'm charging whatever it costs me to do the loan. They're charging their broker fee. So it's going to cost you guys more money than if you just came to me directly, because I don't have a broker fee. I am the lender. Does that make sense?
Let's say I have trapped equity in my rental properties. Do you guys have a line of credit that I could tap into?
No.
You don't have that?
No, what he's asking is like kind of like a HELOC for an
Yes.
investment property. So HELOCs are a home equity line of credit, and there's different kinds of HELOCs. There's open-ended ones, closed-ended ones. Typically, banks do HELOCs, depository institutions they call them. Banks do HELOCs, and they really only want to do it on a primary residence. It is really hard to find. I met one guy one time who had like a credit union who loved him, and so they did a HELOC on one of his investment properties. But for the average Joe, like the rest of us, it's typically only on your primary.
I have one. One of my investment property was a small local.
Yeah, small local bank, yep. And they can make up their own rules. Yep.
So you end up talking about Subto
Yes.
lending. Can
Yeah.
you kind of go about or talk more details on what you mean by that and kind of how you guys do it?
Yeah, so Subto, does everyone know here what a Subto means? Philip, do you want to give just a brief, what's a Subto?
Taking over someone's mortgage.
Yep. So a couple things you guys want to be careful when you're taking over someone else's mortgage. You're making the payments, but the mortgage is still in Sally Joe's name, right? So Sally Joe owns a house. She sells the house to you, Subto, right? You're going to start making Sally Joe's payment, right? But Sally Joe, and you're going to transfer the deed into your name, correct? Everyone with me? So Sally Joe still is on the mortgage, but you're on the deed. Technically, you've just done something you weren't supposed to do with the Sally Joe's lender, and technically the lender can call the due on sale. You've now triggered the due on sale clause, and they can call that mortgage. Does that make sense to everyone? Okay. In reality, I've never seen it happen. But technically, legally, it could happen, right? So be careful, right? And just be aware of everything. So at some point, though, Sally Joe, was that her name, Sally Joe? Sally Joe's going to say, hey, I want to go buy a new house. And when I went to go buy a new house and I went to get pre-qualified, my name is still on this mortgage. Oftentimes, the original seller doesn't think their name is on the mortgage because they're not making the payment anymore, right? Their name is still on the mortgage because you didn't refinance them off. So they go to buy an owner-occupant house somewhere else. They're now not going to qualify maybe, right? Because they still have this debt on their credit. So now they're calling you saying, hey, you got to get me off this mortgage, right? So how a DSCR loan can help you is you then can go in and refinance. Now, hopefully you've owned the house for 2, 3, 5 years, right? And you have some beautiful equity built up in the property. You're just going to do a DSCR loan. We're now going to put the mortgage in your name. The property is already titled in your name, right? So it'd still be titled in your name. Now the mortgage is in your name. Sally Joe is off the mortgage, so she's free to go buy her other house. And you can leverage that refinance opportunity to pull some of your cash out. Make sense? Yes? Okay, awesome.
you're pretty versed in some of the creative options that people do. Are you?
I have my good days.
Are there other ones that you have experience with? I myself have been doing some venturing into credit sponsoring or credit partnering with folks who already have, let's say, a property and they want to refinance it. So I would create an LLC with them and go on as a partner, them using my credit profile to leverage my credit to do so,
Yep.
or potentially seller financing with a seller carryback or something like that. So are you comfortable with those types of scenarios?
Yeah. I talk to investors. Philip, I don't know. I talk to, it depends on the day. Sometimes I talk to 2 investors a day. Sometimes I talk to 20 a day. 20 is a lot in one day. I'm really tired at the end of the day. I counted up one time, I think on a year basis, I talk to 1,000 investors a year. So I hear all sorts of crazy stuff that you guys are thinking about doing that you can't do, and then I can tell you stuff that you can do. We don't hold any seconds. No lender like me, an institutional lender, corporate lender, we're never going to want a second. We're never going to allow seconds because we don't want anyone else to have access or be able to get our property if it ever went into foreclosure. So think about this from a lender standpoint. They want to do a loan and make money. They do not want the house. So when you think, oh, they'll just foreclose, no big deal. Do you know how much it costs and how much time it takes to foreclose on a property? It's typically $20,000 and anywhere from 6 months to 2 years for the average foreclosure. Lenders do not want properties. They don't want to be an asset manager, right? They want their money. They want you to make their payments. They'll work with you to whatever to make your payment because they don't want the house. So we don't allow seconds because then now we have a cousin that's asking us for the money if we ever foreclosed on the house, right? So we don't ever hold seconds. We don't ever allow seconds. When it comes to, I'm sorry, remind me, what was we're talking about seconds. Oh, the being a partner, right? So I oftentimes, like every day, I probably talk to an investor who doesn't have something or has a hurdle. A hurdle would be, I don't have enough cash for this deal. I got a great deal on the table right now, I got it, but I'm short 10 grand. Or my credit score is a 660 and I can't get the LTV I need unless I'm over 700. So there's often hurdles, and it typically is credit or cash, one or the two. Those are the 2 big drivers, right? And so oftentimes what I will tell people, or experience, our new construction does require 2 in experience. Now those 2 could be heavy rehabs, which is unusual. Most lenders are going to require you to have new construction experience to build a whole entire house, right? But if you've done some heavy rehab projects and you're going to hire a GC, we have the internal construction department, so we're going to monitor and manage that project with you. So that's okay for us, but most lenders that's not okay with. So experience is also something in new construction. Because inventory is so low, a lot of investors are getting into new construction that they would never even have thought about before. So I'm getting a lot of new construction questions, which is good, right? So I had a guy yesterday, he has okay credit, but it's under 700. He has a ton of cash. When I say a ton, he has plenty of cash, but he doesn't have experience. He was a general contractor, but he never owned the properties himself. So he feels like he has the experience like you were asking about, but technically he doesn't. Because legally owning a property that you do work on is different than being the general contractor. As a general contractor, you could walk if you needed to, right? Being the owner of the property, you're responsible for that project, for those payments. It's just it's different, right? So we want you to have experience and ownership as well as the renovation aspect of it. So yes, what I suggested to him was you just need to go find a partner. Now, be careful who you partner with, obviously, right? Make sure you trust them. But let's say you don't have the credit score and someone else does. Partner with that, go form an LLC. You guys are 50-50 owners. They've got to be on the mortgage if we're using their credit score. You do not have to be, but you can be an owner in that LLC. So legally you are an owner of that property. Yep, was that a long answer to your question? All right, good questions, guys. Any others? I kind of don't remember what's on the next slide, Phil. Oh, it's just me. So if you guys want to, my QR code will be the easiest thing if you want that. I feel like some of you already have it though, right?
If there are no more questions, so I go one.
Shoot.
Is it still
Yeah, sure.
Short-term loan that your firm provide, do you consider that as a balloon? Like what happened after 12 months?
you better pay up.
So this is like a balloon, okay.
So on short-term loans, just like a private money lender or hard money lender, right? If they're going to loan you money for 6 months, they want their money in 6 months, right? Because we work with a lot of investors and this is all that we do, right? If you come to me and say, I have a new construction, I'm going to build $1 million house and it's going to take me 10 months. Well, then I'm probably going to give you 18 months or less, right? So that you have plenty of time. You can file for an extension with us. Like, let's say we only gave you 12 months and you needed 1 more month. You could file for an extension, but that's going to cost you. It'd be cheaper to get the 18 months to begin with. If you think you might get close to that 12-month, I'm going to give you 18 months. It's like a quarter more in points. So it's really not that big a deal. The fee would cost more than had you gotten it in the beginning. So yes, at the end of whatever the term is, we want our money just like anyone else. You're either going to pay it off or refinance.
Is there, to start working with you, and like if we wanted to start going down that process for,
Yep.
you know, future things of,
Yep.
you know, pre-qualifications, all that kind of stuff, would you guys do hard pulls, or is there a way to start working with you to
yeah,
start doing
good
like
question.
soft pulls on credit?
Yep, good question. I'm actually going to take you at your word in the beginning. You're going to tell me, hey, my credit score is a 760. I'm going to run all my figures as if your credit score is really a 760. Now, if you know it's really a 560, then when I actually pull it, I'm going to know, and then we can't do anything, right? So don't lie to me. It's not worth it. I'm going to eventually figure out the truth. But no, I don't do a hard pull just to run some figures. That would be crazy, right? To get started to work with me, thank you for that. That was a great one. You guys are just going to click the QR code. What I tell people all the time, they will call me and say, hey, I got this scenario. We'll talk it through on the phone, and then I'm going to send you a link. You're going to click on the link. The link's going to ask you 10 different pieces of information. What's the property address? What's the sales price? What's the rental? I mean, it depends on what the is it short-term or long-term, right? So you're going to click on a link, and then from the link, you're going to give me the information I need to run some figures for you. Then I'm going to send you those figures in writing with a little snippet of your options if you have options for a rate. And then if you want to call and we can absolutely go through what the numbers I sent you. I think that, especially when you're a new investor, practice will just make life easier and less stressful. So, I mean, don't send me 10 different ones, but, you know, as you do each one, you'll like, okay, now I get what she's saying. Oh, okay, that made sense, right? And the light bulb will go off. So I would say definitely if you're out shopping, looking at properties, you want to make an offer on one, absolutely just let me know. I'll send you the link. You fill out the information. I can run some figures for you. If it's a purchase, it has the pre-qual letter as page 1, so that's important. Also, too, when you're looking at properties, let's say you're going to do short-term money for either a rehab or new construction, and you know you're going to keep the property. That's your strategy. You're a build-to-rent, right? Let's say that as an example. I actually want to run 2 scenarios for you. I want to run the short-term money. I also want to run the long-term. Because if the long-term, especially on new construction because it's so expensive, if the long-term doesn't work out, that may then help you adjust your strategy for the short-term. Maybe I don't build as big a house. Maybe I know I'm going to have to sell it. Maybe that information helps you here. Make sense? So quotes. I run quotes all day long.
So I have a question. You may not know or know.
I'll make it up if I don't know. It's fine.
So the housing is more expensive.
Yep.
People are working less. There's more jobs, but are they paying enough to afford? I'm noticing the housing, the mortgages are like $2,500 a month.
Yep.
And I'm also wondering who can afford that. You know, just looking at my own mortgage and people that I know that are still mortgaged between $700 and $1,200. What's
Yep.
happening?
So what's happening is the Americans right now are being squeezed, right? So maybe we're making the same money, maybe we're making a little bit more money, right? But housing went up more than what it feels like we're making more, right? So there's that gap. And so it's a squeeze in the middle. And with rates not coming down, there's a lot of people that you'll hear the term lock-in effect. There's a lot of people that own houses at 3-4% interest rate. They can't afford to sell their house because they couldn't afford to buy their own house again, right? So that's why the inventory is not moving like it normally historically would be moving, right? You have these people who are kind of stuck where they are. I have a coworker in California. He's at a 3.5% interest rate. He said he and his wife and his family, they plan to move, before COVID, they plan to move in 5-10 years when the kids got a little older, blah, 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 which is the average common thing that people do, right? They move from the starter home into the next move-up house. And that gets that inventory back on the market. That gets the inventory flowing, right? Well, with rates now being at 7.5%, and you're at 3.5%, you can't afford to sell your house. Yes, maybe you make a ton of money by selling it, but then where are you going to live? What are you going to do? You can't afford to buy the next house. So that is a struggle right now that is going on, and that is what's causing a lot of our inventory shortage.
Okay, so I plan to move to Tampa. And their houses, the $1 million houses look like shacks. And I'm like, how do people do this?
If they're living there for an owner-occupant, they do a different occupation. They have an occupation that can support it. Yeah, it is surprising when I look at the net migration. Then you can tell I'm a total dork. When I look at the net migration, right? It's a map of where everyone in the United States is moving around to, right? And you can see a full trail from California, from California to the southeast. So the southeast has more affordable housing than overall than any other part, with jobs and population and infrastructure, than most other parts of the United States. So there's a tremendous amount going to Alabama, Florida. Southeast is much more affordable housing than northeast, right?
Yes. Do y'all work with co-working spaces, people that inside the investment area and that side of things?
What do you mean when you say coworker?
Co-working, so it's just the same thing as real estate, but just doing it's commercial buildings.
Yeah, so I don't do anything on commercial buildings. Nope. So if there's a business in there, a restaurant in there, anything like that, nope. And just heads up for you guys, same thing with apartment buildings right now. There is going to be, as we can see, remember the new construction slide? And on the new construction, there was the permits and the starts and the blah, 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 right? So we know there's a tremendous amount of apartment buildings coming on the market in the next 2 years. And it's most likely going to be very saturated. So I am getting more and more calls from investors looking for financing for a 12-unit building, a 20-unit building. They can't find that. And that's because banks have said, we're not lending on those properties anymore because we know there's going to be too many of them. And if there's too many of them, you won't have them occupied. If you don't have them occupied, you might not be able to make your payment. And if you don't make your payment, I don't want that loan. So a lot of local banks are local banks have a lot of issues going on right now with their capital requirements and other regulations they've got going on. But a lot of it is commercial space, like office buildings and such. There's saturation in that market, as well as the multi-unit small apartment buildings. We will lend up to 8, but over that, you're going to have a tough time.
All right, do you guys do FHA? And if you do, you don't do it?
Nope.
Do you know?
I only do the investor.
Okay.
I do have friends. And so if you were going to buy a house to live in, I get it all the time. People call, hey, can I get an FHA or VA loan? Just let me know, and I'll send you to Jimmy or Scott. Or.
Are you still seeing the rates can be as low as it's 3.5%, or have the rates gone up generally with the
You mean
FHA?
down payment, or you mean interest rates?
Sorry, down payment.
Down payment. Yeah, down payment on FHA is still 3.5%. That's actually federally regulated, so you literally have to have an act of Congress change what the down payment is. So VA loans are 0, FHA is 3.5. You can get a conventional for 3 if you have a good enough credit score. Yep. So I used to do owner-occupant, those loans. I did that for like 20 years. So just ask me. I can tell you. 10 years, because I'm not that old, so 10 years, not 20 years.
And just thinking in the realm of like working together and growing a network, curious, do you do like referrals or any kind of partnerships along those lines with investors who bring you more business or what have you?
It just depends, and that's something you and I can talk about. Yep.
Anybody else with questions?
Are we good?
All right, so let's just give
All right.
a round of applause.
Awesome. Thank you, guys. Thanks. Thank you.